Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features John Buckingham of the Prudent Speculator. John writes a fantastic newsletter, value-oriented, and he did a data-driven election special, which dove into a lot of different topics. Do stocks do better in high tax regimes, low tax regimes? Do stocks do better under Republicans or Democrats? Do they do better in years 1, 2, 3, or 4 of a presidential term? All kinds of things. So my girl Hedda Nadler hit me up and said, "Hey, John's got this thing. Do you want to do it? And do you want to do this episode?" I said, yes. So here we are. And I thought it was a fun discussion to have. I hope it's a great one to listen to. As always, nothing in this podcast is financial advice. Everything in this program is for entertainment purposes only. Do your own due diligence. Please consult a financial advisor before making investment decisions and all that. Entertainment purposes only. Might have said it, saying it again. Anyway, if you're looking for a newsletter in your life, John's isn't a bad idea. That's my 2 cents. So enjoy the program and have a good one. I do want to give a shout out to my editing team at Speech Docs. You can find them on Twitter at Speech, and Docs is DOCS. Dax and his team are fantastic. All I can say is that Dax and his team offer incredibly good value, and I very much appreciate what they do on the back end of this show. So if you are somebody who is thinking about starting a podcast, please consider Dax and his team at Speech Docs. That's SPEECHDOCS. All right, ladies and gentlemen, I am very excited to be joined by John Buckingham today. John, I don't know exactly how to introduce you, so I'm going to let you introduce yourself and talk about what you do a little bit, because I don't want to just say that you write a newsletter, because that is not true. So why don't you talk about what you do?
Well, I'm essentially chief cook and bottle washer, as I like to say, at the California operations of Kovitz. Kovitz is a Chicago-based wealth manager. My little area here is, well, not so little anymore. We manage about $1 billion of assets, but we are the publisher of the Prudent Speculator newsletter, which has been around since 1977, believe it or not. I've been here since 1987, so 37 years plus of doing what I love, which is researching stocks, writing about the markets, helping clients grow their wealth over the long haul, and commenting on the markets. And what we try to do is provide a lot of data, a lot of numbers to try to take the emotion out of investing. And it's certainly a difficult thing to do for many investors, especially when you're in an election cycle, for example, where there's a lot of sensationalistic headlines, and it's very hard to kind of keep rational and calm. And so for 37 plus years, and frankly, for 47 plus years that the newsletter's been around, that's been our mission, is to try to keep folks on the path to achieving their long-term investment objectives.
So are you going to come here and you're going to tell me that neither candidate is going to crash the economy?
Well, I'm going to tell you that I don't know.
All right. I like that.
The people who claim they know don't know. Whether you want to, Paul Samuelson said stock market has predicted 9 of the last 5 recessions. I'd argue that economists have predicted 99 of the last 5 recessions. If you think about where recession probability was just 2 years ago, we were supposed to be in recession, if not right now, back in 2023 or early 2024, and we didn't have one. So it's very difficult to forecast the economy, even if that's your only job. And so what I'm here to tell you is that life will go on once election day has passed. And frankly, we may not even know who will be president come Wednesday morning or late Tuesday night. In all likelihood, we won't know for a few weeks. And of course, many people will say, well, that's awful. How are we going to survive with a contested election? Well, we had one in the year 2000, people might remember, the hanging Chad election in Florida, which, believe it or not, really wasn't decided for, I believe, 19 days after Election Day before the Florida Supreme Court ultimately ruled that Bush had won. And then, of course, there were lawsuits that went on after that. So it's not as if what we're dealing with today and the threat of we're not going to accept the results on either side potentially. It's something that's happened before. Heck, it even goes back to 1800s. Have been elections that were questioned and ultimately ended up in Congress to decide. So what I hope people understand or get across from all of the writings that we do and the research we do is that you want to stay focused on your long-term objectives and try to let the noise that goes on around you, fall off your back, if you will. It doesn't mean that you ignore it. And we don't know what's going to transpire, whether either candidate wins. If you told me today, for example, that, Trump is going to win, what are you going to do with your portfolio? Well, I'm not really going to make many changes in my portfolio, if any. And if you said, Harris is going to win, I'm not going to make many changes because, frankly, we don't know how the market will react to the expectations of whatever policies the new president might implement. And we also have to keep in mind Congress plays a role in all of this as well. So if you don't have control of Congress, then it might be a little more difficult to get some of those policies implemented. And frankly, for many of what we've been hearing on the campaign trail, it's kind of policy du jour. So we don't even know what the candidates might ultimately decide, should they get elected. So long-winded answer to your question, but the bottom line is the sun will come up the day after Election Day. The economy will continue to grow over the long term as it always has. And the stock market, in my opinion, will also remain rewarding for investors who can have the stomach and discipline to navigate through whatever short-term turbulence might occur.
Now, I think a common refrain that you hear among those that like to scare people for a living, and maybe even those that don't, is the market is extremely richly valued right now. One of the highest valuation periods, I think going back to 1980, it's probably the third highest. So how can you be excited about what the market can provide when I think Goldman's out here saying maybe only 3% and we've got all this election uncertainty? How do you reconcile those thoughts?
Right. Well, first and foremost, we're not investing in the quote unquote market, meaning the S&P 500 or the NASDAQ composite index. We're not investing in areas of the market that are richly valued in our view. Our portfolios trade for PE ratios on a forward basis in the 14 range. The S&P 500 is over 20. And so there's a lot of expensive stocks and a lot of inexpensive stocks. It's a market of stocks and not a stock market. So I'm investing in what I believe are undervalued stocks, companies that are not richly valued. Yes, we do have some stocks that have performed really well and have higher multiples, but overall our portfolios are very reasonably priced. So that's the first response I have to that issue of the market is expensive. And many people will go back and say, well, this looks a lot like the year 2000, the lead up to the tech bubble bursting. We have the AI euphoria. NVIDIA's market cap has exploded. And, NVIDIA is at least a profitable company, unlike what we saw back in the year 2000. But I've lived through ups and downs and a lot of valuation spikes in various areas of the market. And if this is a repeat of the quote unquote lost decade, because I've been seeing a lot of commentators talk about, we might have another lost decade. You mentioned Goldman Sachs maybe suggesting 3% returns going forward, which they might equate to a lost decade in equities. But keep in mind, from 2000 to 2009, the S&P 500 was flat or down a smidge. So that was truly a lost decade. But value stocks, undervalued companies, actually gained ground. Now, it wasn't a great decade because we had the great financial crisis in there. We had 9/11 in there. But value stocks had solid returns in the 6-7% a year range during that time. So just because the overall market, as measured by the indexes, could be going south or treading water, doesn't mean that all portfolios will be having the same situation. And it works in reverse too. I mean, in all candor, value-oriented stocks have had lower returns. They've still had great returns over the last decade, but the returns have been lower than with growth stocks. And so in my mind, that creates opportunity. And while I've argued that we are value investors, keep in mind that we want our companies to grow as well. So we're trying to buy reasonably priced companies, solid businesses that will grow over time. We just don't want to overpay for them. So many of our investments have graduated, if you will, from the value category to the growth category. And we own things like Apple and Microsoft and Alphabet and Meta platforms. We own stocks that many people would call growth stocks today, but we bought them when they were truly value stocks. And we still think there is upside potential in them. While, to be candid, also, we've taken money off the table along the way on many of those of the names that have gone to the moon, so to speak. So long-winded answer is that I think that valuations are certainly important. I agree with you that the S&P 500 is richly priced, but you also have to keep in mind that it is roughly 7 stocks or so that make up the lion's share of that index. And while we own Microsoft and Apple and Alphabet, we own several of them, we don't own the more expensive ones like NVIDIA. Unfortunately, of course, we used to own NVIDIA way back when. It was a value investment at one point in time, but it's not. And maybe it will become a value investment again. But that's what discipline is all about. Trying to buy things that are reasonably priced and then hold them as they become fairly valued and take money off the table or exit them completely. And then, like a farmer, you harvest your crop and you replant the seeds into other undervalued stocks. And we've been doing that for 47 years, independent of where the quote unquote market is valued at.
Yeah. How did the newsletter begin? Because I heard about it. It was years ago. I heard about it in Barron's, and then I wanted to see what it was. And the Chicago Public Library had copies of it. So I used to go there and read it. And I always used to think like, man, how'd they get distribution here or whatever? Yeah. So I'm curious to hear the origin story of it.
Sure. Well, the newsletter launched in 1977 by a gentleman named Al Frank. And Al was my mentor, and he was a novice investor, frankly, who was college professor. He did a lot of things in his life and came to investing very late in life. But Al was somebody who was interested in the stock market, and primarily because he went through the school of hard knocks. He had a little bit of money and he went to a stockbroker, and the stockbroker said, the stock is at 30, it's down from 50, and it'll never see this price again, implying that it'd go up. Well, it never saw that price again because
it went to zero.
Yeah, it went to zero. So Al thought, well, I have 2 choices here. I can either try to figure out what works historically from investing. And you mentioned the library. Al was a cheapskate by trade. And so he went to the library, looked at some books, The Intelligent Investor by Ben Graham, another book called What Works on Wall Street. I believe Jim O'Shaughnessy wrote that. And what he discovered was that stocks trading at inexpensive valuations of earnings, of sales, of book value, they tended to outperform over the long haul. And I don't want to say a light bulb went off, but that's how Al lived his life. He was a bargain hunter. And most investors out there are, and most consumers are seeking a deal. I don't care if it's a Ferrari or a Lamborghini. Do you really want to pay 2x for it if you can get it for 75% of X? It just is logic that value investing should resonate with most investors. The problem for many, of course, is doing the homework, crunching the numbers and understanding and trying to separate what's an inexpensive stock from what they might call a value trap. So Al set out to invest on his own. He did that for a while. And friends said, hey, you like to talk about the stock market. Maybe you should write a newsletter. And Al said, I'm not qualified to write a newsletter. I don't have a formal financial degree or training or anything like that. So the friends gave Al a few newsletters that were out there at the time, and Al looked at it and said, well, these aren't very well written, not well reasoned, and I think I could do that. So in March of 1977, Al set out and published the first edition of the newsletter, which was then called the Pinch Penny Speculator, in honor of Al's desire to pinch pennies. And it was truly a diary of his investment experience. So Al started with $8,000. And a passion for investing. And he would buy a couple stocks in each issue. And unfortunately, he wasn't made of money. He didn't come from a lot of money. So he didn't have much more than $8,000 to start with. So he could only buy a handful of stocks. And then he got to where he liked more stocks than he could actually own. So he added those to the newsletter buy list. And he did very well. On the first decade of an Al joke, of course, he made 40% a year. From 1977 to 1987. Then he hired John, and then he only made 20% a year.
Well,
and so
it'll happen.
But, you know,
40% a year is the real deal.
yeah, he did extraordinarily well. And you mentioned maybe reading about it in Barron's. If you go way back, you know, in 1980, Al Frank was discovered by the gentleman named Mark Hulbert in the Hulbert Financial Digest, which was launched to evaluate all of the claims that newsletter writers would make. Because again, it's an industry where people will claim that they told you to buy NVIDIA at the bottom and told you to sell it at the top. But Mark Hulbert came along and he said, well, I'm going to actually get these newsletters and I'm going to track them. And I'm going to evaluate it and say, okay, and I'm a subscriber. So he didn't say, well, gee, I'm going to trust the guy who said he bought it at 10. I'm going to get it in my mailbox 4 days later, and it might have been a 12. And I'm going to use 12 for the price that I put in for the buy of that particular security. So Al was discovered, quote unquote, discovered, primarily because of his track record in Hulbert. And we had the top rated investment newsletter. And we still have the top rated investment newsletter going all the way back to 1977. And so that's kind of how the newsletter got going. It was really just a diary of Al's investment experiences, warts and all. You know, he was honest. He didn't bury his losers. He called it like he saw it, and he presented all the info and lived and died with the stock market. Now, happily, when you make 44% a year, you make some real money.
Yeah.
And Al was able to parlay that into an investment management business where he'd manage assets for folks, friends and family and all those sorts of things. And the asset management business, when I got here in 1987, was something on the order of 50 million of assets under management. And we had
it's a good sized business back then. That's not 50 million of today's dollars. That's like real dollars.
Yeah. And we had a couple thousand subscribers. And, you know, over time, the market went through its ups and downs. The crash of 87 was not a good thing, especially for folks who weren't investing in blue chip stocks, as we weren't. We were in more smaller caps, micro caps. So that was a tough year. 1990 was a tough year. 94 was a tough year. But there were all of these great years in between so that you could have this fantastic long-term return. And that portfolio that Al started in 1977, we still manage it for his estate. And it's averaged about a 17% return since the inception of the newsletter. Again, with going through downturns in 87 and 90 and all those other negative periods. So the newsletter has always been I don't want to say our bread and butter, but it's really what our claim to fame. And I would argue our differentiator versus many of the other folks out there. We truly put our money where our mouth is. Al did it in 1977. He passed away in 2002. And I became the editor, even though I was doing the research and portfolio management from 1990 and writing a lot of the newsletter. In 2002, I became the editor. So in early 2003, I launched Buckingham Portfolio, original name.
Okay.
So I followed in Al's footsteps, and I took the $8,000 that Al started with and inflation adjusted it and started with something like $22,000 or so. And that's grown to 1.4 million. Since 2003. And so the returns have been very good and the strategy has proven itself over time. What I've always liked is that we actually do what we say we're going to do. I mean, I know that sounds silly because, of course, everybody should do that. But I don't lose sleep about value stocks potentially underperforming growth stocks here in the short run because I didn't promise investors that I would go out and try to find them whatever was hot. I didn't say, well, gee, equities are boring now. Let's buy Bitcoin and let's run off and do that. We are what we are. And for people who want to grow wealth over time, I think we have an excellent strategy and philosophy. But most importantly, we're disciplined in implementing it. These days, many value investors have hung it up, for lack of a better term. They found that they don't think they can compete anymore or can have decent returns. And I think there's always going to be a place in an asset allocation mix for a value-oriented strategy, especially today when, as you mentioned, the S&P 500 and growth stocks are very expensive. So the valuation gap on various financial metrics between value and growth is as wide today as it was in the year 2000. And as we said earlier, if we could have another lost decade like that, we'd be very happy from a business perspective because we would be one of the best performing newsletters and money managers out there. But even though we might not have as much money as if we've had like this lousy, quote unquote, lousy period for value, I know that investors are always going to chase returns and chase performance, but we feel we're like the tortoise and the hare. And we plod along. And again, we're disciplined and patient in what we do. And we think eventually we will get to the finish line ahead of most other folks. And the problem when you're investing, I guess, in whatever is hot or sexy, is that inevitably that's going to go through some difficult times, and sticking with it can be really, really hard. I mean, even if you think about NVIDIA here recently, the stock went from what, $130 to $100 and very quickly in Q3. And so for many investors, it's like, well, of course I would have stayed with NVIDIA. It's a great company. Well, would you have? And did you? I mean, you go back to like Amazon way back in the tech bubble. Amazon lost 95% of its value in the tech bubble. So all of these people who said, oh, I knew Amazon was the greatest thing since sliced bread when it first came out. How many of them actually stuck with it to reap those long-term rewards without missing a substantial part of the great run over time? So again, discipline, I think, is super important. And we haven't changed our stripes. Yes, as we like to say, we reserve the right to get smarter. Technology allows us to crunch more numbers, to evaluate more metrics. That original book that Al looked at, What Works on Wall Street, was really looking at price to sales as a key factor in returns. And then if you thought about value investing versus growth, it was pretty much just price to book value was the metric. So we don't live by just two metrics or one metric alone. We look at a variety of them. And again, trying to separate out the value traps from the truly undervalued stocks that will generate fantastic returns. And it's not like it's easier today than it was when I started. The business conditions change rapidly. For example, we bought, because we thought it was inexpensive, Facebook before it changed its name to Meta.
Yep.
Well, that focus on the metaverse caused our investment that we bought at 150 to drop to 90. Yep. As Mark Zuckerberg decided he was going to funnel, money into the metaverse.
I had the pleasure of wearing this one too.
and so, but when you looked at it, it's like, well, there was still a mountain of cash on the books. There was still tremendous cash flow coming in. And we thought that Meta was still undervalued at $90. We didn't sell it. We rode with it. And Meta went from being believe it or not, it was in the value indexes.
Yep.
A couple of years ago. Now, of course, it's at, 600. And we've actually taken some money off the table along the way. But again, that illustrates patience is so important. And for many may have thought that Meta was a value trap. And it could have been if Zuckerberg, I guess, didn't see the proverbial light and decide, okay, well, I'm not going to throw all of our money at the metaverse.
Stock pricing going down that much can cause a man to get religion.
Well, it can. Of course, it doesn't.
And then it's funny, it went back up and now he's kind of maybe has less religion. But if nothing else, he proved that he can operate in the year of efficiency, right?
Right. And of course, he was, if you were to vote best manager or worst manager of a business, he might have been the worst manager of a business, during that time span, because, of course, you're evaluated based on your stock price. Yeah. And you could be a very good manager happening to operate in a tough biz, and that makes you look bad. But vice versa, you can be an awful manager, but you're in the right place at the right time. So again, the moral of the story is stick with your discipline, stay patient, and it's not easy to separate the value traps from the truly undervalued stocks. And that's why we also believe in broad diversification. I mean, when people ask me what my favorite stock is, it's extraordinarily difficult because I have about 100 of them. I like
Do you have that many?
I like all my children equally. Yeah, in the newsletter, we have actually about 120. And that's spread across. We have a variety of managed account strategies. And so the stocks that are in the newsletter encompass all that we have in our diversified multi-cap value-based strategies. And so we have an income-oriented strategy. So they're going to have more higher dividend payers in that. And then we have our traditional flagship, the Prudent Speculator strategy, which doesn't require dividends, but we certainly do like dividend-paying stocks. And that might have been somewhat of an epiphany over time as we continue to do our research. What we learned is that dividend-paying stocks historically have had higher returns than non-dividend-paying stocks, and they have lower standard deviation, lower volatility of those returns. So, investors are
Somebody
constantly
that
seeking.
cares about tax efficiency is pulling their hair out right now, they're saying, but it's not tax efficient.
Well, we have a long-term oriented strategy. So from a tax efficient basis, when your average holding period is 6+ years, that makes you pretty tax efficient. And then when you have
I just mean the dividend versus buyback. I happen to also, I prefer dividends, but that's because I actually like the physical. I mean, it's not physical, right? It's digital, but I actually like cash coming into my account. It's like a forced discipline of taking money off the table. Now, of course, you can go buy more, and then that sort of negates the forced discipline. But I think behaviorally it makes some sense.
Yeah. And I think dividends help investors navigate market ups and downs. Yeah. What we try to convey to our clients, because many of our clients have assets, not just in equities, but in other investment classes. So if you think about real estate, if you own a piece of property, what are you getting out of it? Well, you're getting income from the rents you receive. You have some outflows from the upkeep. And then over time, you're hoping that you have appreciation of your asset. But you're focused in the short run on your cash flow and on your income that you receive. So if you can kind of eliminate the noise of market fluctuations, because if you truly valued your house or your apartment building on a daily basis, I can assure you it's going to be more volatile than the stock market would be. The prices would gyrate all over the place. The problem, if you will, or the good news for a real estate investor is you're not selling your property every day and you don't care per se. Right? If the comp is improved or not improved, you might just nod and smile and say, okay, well, I'm not selling. Who cares? Right? What matters is the day I sell where it is. So you can apply that same logic, hopefully, to your equity portfolio. And so that's what we try to encourage people who are income oriented to focus on the yield that you're getting out of your companies. And one of the things that I think investors tend to forget is that dividends increase over time. And for example, we have a slide that we use in our presentations that looks at the dividend income on TPS portfolio, which is the Al Frank portfolio that has been going. Money hasn't gone into the portfolio. Money has actually been taken out of the portfolio. But believe it or not, the dividend income has more than doubled over the last 10 years. And so and it's not like we've decided to buy higher yielding stocks. It's that the businesses that we own have increased their dividend over time.
Yeah.
I own
shares.
Yeah. I own Apple. I bought it in the year 2000. And so my Apple cost basis is something like 25 cents.
Oh,
well, my yield, Apple's paying, what is it paying in dividends now? $1 a share on an annual basis, something in that range.
That's not bad, John. I think you want more of those.
Well, right. So my yield on my cost is like 400% on Apple, even though the overall yield on the stock is 0.5% or 0.8% or something like that. So dividends, like you said, it's tangible. I think it can help people sleep better at night. And again, our research has shown that dividend paying stocks almost give you the holy grail of investing, higher returns with lower risk or lower volatility. And so I think dividends are a significant component of what, or they should be, of many investors' portfolios.
So I hear you say that you're a value guy. You still own Apple. The Apple you bought for 25 cents was such a different story from the Apple that you own today.
Right.
And how do you go through the ownership of an asset like that without being myopic on a news event or worrying at any given time, is this overvalued and should I sell it? Or do you trim as you see valuation go up? It sounds like you've said a couple of times we've taken some money off the table, but how do you navigate those waters?
Yeah, well, the reason I'm not in the beaches of Ibiza or the south of France is that we have sold some Apple along the way, quite a bit of Apple. In fact, my first Apple sale, I think, was at a split adjusted 75 cents. When I look at where it is today and say, boy, dang, I wish I never would have sold that. But prudent portfolio management and risk mitigation forces us to be very cognizant of the weightings we have and the exposures we have to individual stocks. So we've talked about Apple here recently. We trimmed some more Apple. And again, the stock has performed extraordinarily well. Warren Buffett was selling a chunk of his at $185. We got $50 more than Buffett did when we trimmed some of our stake. And so that's how we deal with larger positions that become quote unquote concentrated. And for us, keep in mind that our portfolios have roughly 80 stocks in them, our diversified portfolios. That would mean a 1.2% position would be the norm. So Apple had been, the latest sell, we were close to 3% or a little above 3%. And so we gave it a little haircut and pulled it back. Of course, every time we sell Apple, we hear from our clients who say, "Why did you sell Apple?"
Yeah, that's right. Well,
and on the other side, there are some that have those kinds of capital gains, and so many of them use it as a donation vehicle to gift stock away. So, but it is a difficult thing, and this is why it's an art and not a science per se. We're always looking at the numbers, so there is certainly a heck of a lot of science that goes into it. But when we bought Apple back in 2000, they weren't making any money. It just had a fantastic balance sheet, loaded with cash and minimal debt. So at the time, and this was all before all the splits, but we paid something like $14 a share for it, and it had about $8 a share of cash. And it had a rabid base. Now, granted, it wasn't huge, a rabid customer base that loved the Macs and the Apple products. And so we didn't know that the iPod, which was the first real mass consumer product, that would be the greatest thing since sliced bread. Heck, Steve Jobs didn't even know it. When we bought it, it was like kind of a footnote almost in the financial statements. Oh, we might sell 60 million of these or something. And going back, and not to harp on Apple too much, but there was also some antitrust stuff going on with Microsoft. And Microsoft was actually forced to write software for the Mac as part of a DOJ settlement, if my memory serves. And that certainly helped to save Apple, because there were questions of whether Apple was going to survive, believe it or not. And so it wasn't an obvious investment at the time. And Apple, frankly, wasn't stock number one on my list. It was stock number 73 or something. And we bought Apple in October of 2000, and 3 months later, it had gone down 35%. 35% in 3 months. And so just because I say it's undervalued, or Al Franke was alive then, we both agreed it was undervalued, doesn't mean that stock's going to turn around and immediately go higher. But for us, it's...
So how do you deal with that? You got a stock, you like it, you say, hey, it's a clean balance sheet, customers like it, buy it down 35. What's the conversation like in the office?
Well, the conversation, if we have something that has declined in value precipitously and we still like the case for the company, we buy more.
Yeah.
Our inclination has never, ever been that the market somehow knows something we don't know. And we do not believe in stop loss orders. Frankly, we would have been stopped out of most of our stocks. Very few of our stocks have we ever caught the bottom on. There have been a handful. I think Alphabet, we got lucky and caught the bottom on. Microsoft, we may have caught the bottom on when we bought it, but many of them, like the Meta example, the Apple example, many of them declined significantly. So it's revisiting your thesis, revisiting the numbers. And if, frankly, nothing has changed in your viewpoint, then we would definitely want to be buying and not selling in a situation where the market has provided you opportunity. And again, keep in mind, we're long-term oriented. So our expectation is that the money that's entrusted to us, and our own money, is earmarked for 5, 10 years, or in many instances, it's the clients never need it. It's for next generation. We have clients where we're on the grandkids. The original client has passed away. Their kids are still with us, but now we have accounts for the grandkids. And so you're looking at multi-generational wealth. And for many investors, they tend to kind of forget about that, is that, for some, it's my objective is I don't want to ever run out of money. I don't want to be broke. I want my money to last. But for many folks, they need to think bigger than that, which is, what do I want to do with this? What do I want to fund, or do I want my kids to get it? And it's fascinating, the miracle of compounding, which I'm sure you're familiar with. I mean, it's amazing how relatively, I don't want to say medium returns can grow over time. And when you think about life expectancy, I know that COVID, of course, cut into that, and we have the fentanyl and other things that are causing some questions about.
We'll call it adjusted life expectancy.
Yes.
In Wall Street.
And if you've made it this far, say you're 60 years old, and you made it this far, the actuarial tables, not to be morbid or anything, might suggest that you have 25, 30 years. Yep. You have good genes, you might have a longer time span. So this old idea that Well, you get to be age 65 and you retire and then you die at age 70. So you really need to be conservative with your money. In my humble opinion, people need to really revisit that and understand that their money needs to last them for several decades in quote unquote retirement. And I know that equities are volatile and I'm partial to stocks, but we understand that there are other asset classes that can help you navigate the volatility of stocks. But we never view things black and white. It's never like, well, gee, the market is questionable. There's this idea that there's all this uncertainty out there. But when has there never not been uncertainty? There's always been uncertainty. And I don't care if you knew who was going to win. There's still uncertainty in the election. There's still uncertainty of what policies. There's still uncertainty. Well, who's going to win Congress? Okay, well, the Democrats thought they had control of Congress, but then Joe Manchin wasn't truly going along with everything on the Democratic side, right? So they didn't really have control of Congress. So even if you knew the future, you wouldn't necessarily know what's going to happen with stocks. The Wall Street Journal recently had an article. One of my favorite columnists, Spencer Jacob, reported on this. There was an analysis done that said, I'm going to give you, the professional investor, the headlines from the Wall Street Journal. I'm not going to tell you what stocks did, but here are the headlines. The Israel bombs Iran. Okay, so
my guess would not be oil is down 5%. That would not have been my guess.
Yeah, exactly. So, I mean, these are things that if you knew the future, right, you wouldn't necessarily know how to make money from it. And that's the big thing. And so I know your original question was, well, how do you deal with the apples and so forth that appreciate? It's you take money off the table along the way to mitigate your risk, and you continue to participate in companies as long as there is substantial upside potential. And we've always thought, remember when we bought Apple way back when, our target price might have been split adjusted 37 cents or 40 cents. Well, Apple's obviously improved as a business over time and generates a mountain of cash, has obviously a huge base of customers. And, your phone is more important almost than your life to many investors these days, or many consumers these days. So you have to have your phone. Even if you're on welfare, you still have a phone, it seems. And so that's super duper important. And obviously the Apple ecosystem is tough to duplicate, and it's tough to fathom swapping out to a different phone maker. But anyway, the moral of the story is we still think there's upside potential in Apple, and that's why we own it. But we've taken money off the table, and we will continue to take money off the table if the valuation is such that we think it's getting a little more toward the fair valuation range from the truly undervalued range. And Apple becomes also a source of funds for us. So you mentioned earlier about if the stock goes down, we might want to buy more. So with the Apple money, I can't tell you what we bought because it hasn't come out in the newsletter yet. But we did buy more with our Apple proceeds of a recent sale of a stock that had gotten beat up on earnings. And that's the great thing, I guess. I like to call it a great thing, is volatility is the friend of the buyer of long-term values. And so when the markets do what they usually do, you'll have stocks that go up a lot, stocks that get hit hard. Usually those moves, especially nowadays where liquidity in individual names is very low, you'll get outsized moves. I mean, should Tesla have gone up 19% in a day on its earnings? Well, it did. That doesn't mean that Tesla was worth 100 billion more, whatever the market cap was, simply overnight. It's just that investors decided it was.
Yeah,
and
well, that's
so
like McDonald's and the E. coli, right? I saw that was like a $20 billion hit. I'm thinking, how many of these lives, how much is these people's lives worth?
And if you were trading in the after hours on that news, right? We own Tyson Foods, which is a meat producer. Well, Tyson was down 5% in the after hours because it was the quarter pounder. Well, then the news came out. It wasn't really the quarter pounder. It was the onions, and so the onions were the problem. Now, I know that meant maybe fewer quarter pounders would be sold. Of course, now we're back to selling quarter pounders at McDonald's. But all of these things in the fullness of time tend to be forgotten. And that's the kind of thing with all of the stuff that happens in the stock market. Again, people will say that I need to wait until I have clarity on the election, blah, blah, blah. Well, we didn't have clarity in 2016 when Trump won. We didn't know what was going to happen. We didn't have it in 2020 with the pandemic, and Biden won in a contested election in January 6th. And the list goes on and on of all of the things that if you just looked at that and that was all you saw in the newspaper headline, you probably would never want to invest if all you focused on was the awful things that are going on in the world, because there are, but there always have been scary things going on in the world. And yet stocks over time have proved to be rewarding, not without, of course, volatility along the way. 5% declines happen 3 times a year on average. 10% declines happen every 11 months. Heck, bear markets of 20% happen every 3 years or so. And so the only thing I can guarantee you is that we will have another bear market at some point. And I will guarantee you that we won't know when it's going to happen, and nobody else will. And we will be stuck riding through it. And the hope is it's a bear market like in 2000, where it's a bear market in the index, but not in the average stock. And that those of us who are buying value stocks will maybe not make money, but certainly won't lose as much. But volatility is inevitable, but volatility is what creates opportunity. And long-term investors should understand, and I think most of them do. And it's easy to have this conversation today when stocks are near all-time highs, right?
Yeah.
Indexes are. It's very easy to say, well, gee, don't worry. As long as you have a long-term time horizon, you stick with stocks, because every other downturn has always proved to be, that's been the right advice. And we'll see stories. There was one in the New York Times here recently that said, well, this time may be different. Well, every time is different. They're never the same. And so, of course, it could be different. And again, anything can happen. But for my money, equities, I think, will continue to prove to be rewarding. They're liquid assets, which is a blessing for people who have the patience and discipline. It's not a blessing for people who have itchy trigger fingers. It's very easy to say, oh, I'm nervous about stocks. The election's coming up. Boom, push a button and sell everything. And now I'm an old guy who remembers $39 commissions being discount brokers. I have my first account at Schwab. I opened in 1985 or so, and I paid $39.95 for a discounted trade.
Yeah.
Today there's quote unquote no commissions on stocks, which is great for
just taxes, man.
Well,
just
it's great
taxes.
for trading costs, but there's no friction anymore. So it makes it easier for investors to trade. And studies have
this
shown
is the old, like, investors do better in a load fund than a no load fund because the load, kind of keeps them in it. It's very interesting behavioral finance stuff. The other thing I find interesting is private market valuations are rumored to be higher than public market valuations. And normally, like, historic knowledge, and maybe it ends up being true knowledge, is, well, you should have an illiquidity premium. I almost kind of wonder if it doesn't make sense that there's an illiquidity premium, because it prevents all the bad behavior. Now, do you want to be locked up in a 10-year vehicle with continuation options? That's sort of a different issue. The fees aren't, as beneficial, but just strictly from a behavioral standpoint, I could actually kind of grasp the argument that there should be an illiquidity premium.
Yeah, no, I would agree with you completely. The less you trade, the better you do. Of course, there's a story I like to tell. I can't prove that it was true, but supposedly, and I always say it was Fidelity Investments who did the study, and they evaluated all their client accounts and how the accounts did, and they broke it down into like how often people traded. So the people who traded the most did the worst. Who did the best?
Probably people that forgot they had the account.
Well, or the people who were dead.
Yeah, there you go.
Because they couldn't trade. And I know it's, and yes, maybe I can't prove that story is true, but in concept, what we've found is that letting nature take its course. I keep coming back to the farmer analogy. We plant seeds, and we're planting seeds, and often there's not a lot of reward on the immediate horizon. But you have faith and confidence that the sun will come out, the rains will come, the nurturing that your crops have received, and whether it's short-term business things, whether they brought in a new executive, whether there's a cyclical factor that's going to get reversed, or whether it's just market dissatisfaction because their earnings expectations were 47 cents and they came in at 46 cents. And if we could just round it up to 47, then the stock would have been up instead of down 17%. It's stuff like that occurs that isn't indicative, in our view anyway, of the long-term value of the company. It's more short-term trading noise. And the great thing is that we have the opportunity to take advantage of that, both on the downside and the upside. And so it works in both directions, this illiquidity that we see in the stock market. And I don't know if it's a result of all of the changes that have been made. I've done a lot of television and be on the floor of the New York Stock Exchange. The first time I did it, it was bustling 20 something years ago, this bustling thing. And, today it's a library. The only reason for the New York Stock Exchange seemingly to exist is so that you have a set for CNBC or the other.
Yeah, you got to have somebody somewhere for Rick Santoli to scream, right?
Well, he's in Chicago.
He's in Chicago. He's in Chicago. Yeah. As soon as I said that, I realized I was wrong.
Absolutely. So I'm just always amazed. I walk on there and it's like, okay, you're in the green room. We're going up to the little stand on the floor. And it's like, well, there's nobody here unless they have a tour or somebody's ringing the bell or whatever, closing bell. It's just very quiet and it's all done by machines and so forth. But anyway, the point is that we've shrunk trading costs both on commission and on bid-ask spreads. So it may cost you a penny or two to get in and out, whereas it used to be eighths and quarters when I started in this business, and you had big commissions. But those commissions and eighths and quarters gave you pause. Even if you had a 25 stock portfolio and you were nervous about the market or the election, for example, and you wanted to sell it all, well, in the old days, if it cost you $40 a trade to sell 25 stocks, that's $1,000 of commissions. You might say, I'm not going to do that. I don't want to pay $1,000. Today, you literally might push the button because in your mind, it costs you nothing.
Yeah.
And so I think that's a potential negative for investors who don't have the discipline and the patience. And frankly, it's the number crunching that we think is super important. It's amazing how many people don't know what the PE ratio of NVIDIA is or Apple or any of these stocks or companies. These days, we're seeing DJT, Donald J. Trump, Truth Social. That stock has gyrated all over the place. But, is there really any value associated with that company? Its value is that it's now being viewed as a proxy, I guess, for Trump's election prospects. But the actual business there isn't really much there. And certainly not something there that's generating revenue and income.
Do you typically limit yourself to like the lowest decile of stocks, or do you typically sort of rank them within their sector and then only go for the cheapest in the sector? How do you sort of manage that?
Well, that's a topic for another podcast, perhaps. But I'll attempt to give you the short answer. We every day we screen roughly 2,700 companies, which we consider our investable universe. So stocks with sufficient market capitalization, trading volume, that we can buy them for our clients. And we score those companies on a variety of financial metrics that heretofore have been good indicators of future outperformance. And as you might imagine, as a value investor, they include things like earnings and sales and enterprise value and free cash flow and things like that. And we have a scoring algorithm that evaluates those companies relative to their peers and then further rolls that up and values it relative to the overall market. And in our world, we then bucketize those. So there are 20 buckets of that. So 140 stocks or so in each bucket, 20 being the quote unquote cheapest and on down to 1 being the most expensive stocks. So stocks that we will consider for purchase have to be in the upper quarter of the rankings from 15 to 20. So they have to truly be value stocks. So they have to pass our original valuation screen, which is a backward-looking evaluation. As Buffett says, if backward-looking numbers was all there was to investing, the richest people would be librarians. So that doesn't tell you much or anything about what's going to happen going forward. So that just gets us fishing in the right pond, buying stocks that have value characteristics. But it doesn't mean we're going to buy all of those stocks. It means that now we have a universe of stocks that we can then do further analytics on from a qualitative standpoint, meaning do we like the business? Do we think it's a value trap? Do we think we like management? Do we like the products? What's their competitive advantage? A whole host of things that you would look at. And then there's a further layer of quantitative evaluation, which is forward-looking, which is where do we think this stock deserves to trade over the next 3 to 5 years? And that incorporates assessments of where earnings and revenue might go, what a fair multiple of those earnings and sales might be, and then further discounting back, and do we get enough of an upside based on that 3 to 5 year target price to warrant a purchase. Also keeping in mind that total return is what we're after. So the dividend component of it weighs into that equation as well. So we own a stock like Verizon, which has a 7% yield. We don't need a whole lot of capital appreciation from Verizon to continue to think that's a worthwhile holding. We need modest capital appreciation and the income. And that's what Verizon has been delivering for us here lately. So we're very happy to own stocks like that. But that's the whole idea. We are screening, we are disciplined, 3-step process, backward-looking, quantitative, a qualitative review to hopefully eliminate what I call buggy whip makers, because I'm old and remember that term, buggy whips. And then a forward-looking quantitative evaluation to ensure that it's truly undervalued. Because there are a lot of businesses that are cheap on a backward-looking basis, but they don't have really any earnings growth potential, and they're not likely to get a multiple expansion. There are 2 ways to win on any investment you make. One is that earnings grow and you maintain the current PE. The other is you get a multiple expansion. And it's like, well, gee, this stock traditionally trades at 14 times earnings. Today it's at 10 because of temporary factors. And you get a re-rating back to 14, then you can have appreciation of your stock as well, even if the bottom line doesn't grow. But 9 times out of 10, I shouldn't say it, 98 times out of 100, we are investing in businesses where the bottom line we think is going to grow from here on out. So we're going to get likely a multiple reversion upward back to a mean, and then we're going to get the income or the growth, bottom line growing as well, profits going. So we think we can win twice in that regard.
Yeah, it makes sense to me. I like it. What doesn't make sense to me is you printed some blasphemy in the Prudent Speculator. You said higher taxes are bad, and then you scratched out bad and you said good for stocks, and that can't be true. You must be lying.
Well, that's what's amazing is that no matter how you slice and dice the numbers, pretty much equities have risen in price. So believe it or not, we have looked at tax rates, and this is simply the maximum personal income tax rate. We've looked at tax rates and equity returns and divided them up into higher rates, and the dividing line was 39.6. And so 39.6 and higher, and looked at lower rates. And believe it or not, stocks did better when tax rates were higher. Now, there's a million other factors that go into that. But when you hear people make these claims that stocks are doomed because taxes are going up, and I know that even the presidential candidates will often say that, it's not based on what has happened historically. Common sense, I agree with you, right? All things equal. Boy, if my capital gains tax rate is 20% plus Obamacare versus 28% plus some other greater Obamacare number, I'm going to be happier because I keep more money, right? So, but we don't operate in a vacuum. It's not like that. There's only one factor that influences those decisions. So historically speaking, when you crunch numbers, you will see that stocks have done better under higher tax regimes. And then the natural question is, well, what if taxes are going up, as we're potentially talking about with Harris? Well, we've run those numbers too, and it's the same thing. Value stocks have had a 20% return in those years when taxes have gone up. And then you can say, well, yeah, John, but taxes aren't going to go up in 2025 because if Harris were to get elected, they're not going to get the tax code changed until 2026. So let's look at what happens in years before years where taxes go up. And it's the same thing again, that stocks have done better when tax rates are rising or when they are higher. So the same conclusions are drawn. And it's not just that. I mean, you can look at things like low consumer confidence. That historically has been a signal for outperformance for stocks. Low ISM manufacturing. And we do all these numbers in our newsletter. The low ISM manufacturing. Well, anytime you see something that the media is telling you is bad, your initial response should not be, oh, I believe them, I'm going to dump my stocks. It should be, let's actually test that and look at the numbers. And we do that. We crunch the numbers. And that's what's amazing. Even if the only time that stocks historically have had a sustained down period is when we've had a economic contraction that also is a profit recession. And that's if you knew when the next time that profits on the whole were going down, right? Then you could arguably, if you had perfect timing, you could get in or get out and then somehow get back in. The challenge is in the getting out and getting back in. When do you do that? Because if you remember back to the financial crisis, March of 2009 was the bottom for stocks. Well, Warren Buffett had a famous line. He said, the economy has fallen off a cliff. He sounded about as pessimistic as he's ever sounded. Well, that was the ultimate buy signal. The economy didn't bottom in March of 2009. So if you were had the economic historian book and said, okay, I'm going to go out and buy when the economy's bottom because now we know that things are good again, you would have been doing that in end of 09, early 2010. Same thing with the pandemic. When did stocks bottom in the pandemic? March of 2020. Well, when did we didn't get a vaccine until November of 2020, right? And frankly, the pandemic isn't over. I know that we've forgotten about it, but it's still floating around out there. COVID hasn't gone away, and yet we're dramatically higher. So again, crunch the numbers, take what you hear with a grain of salt. Even what I say, if you say, well, John, you sound like Pollyanna, and no matter what's going to happen, everything will be okay. Well, historically, that's been the case. Doesn't mean it'll happen going forward. Anything's possible. We could get hit by a meteor. Who knows? None of us knows the future, but equities have proven to be very lucrative for those with the courage to stick with them through thick and thin. And investors' market timing prowess has been awful. A company called Dalbar, which is a data company, they evaluate mutual funds and how investors did in them versus how the funds did themselves. And investors are awful. They shoot themselves in the foot. We can look at Cathie Wood and the ARK fund. It has a great long-term return, but there's probably been more capital destroyed in that fund than any mutual fund in the history of the world because everybody bought high. Nobody bought when it was cheap. And so it accumulated a fantastic record. And then everybody bought high. And that's kind of just the way the world works. People chase returns. And I keep coming back. We try to be the tortoise and the hare. We may not be sexy, but we feel that for those who've accumulated wealth, we can help them preserve and grow it over time in what we think is a disciplined, and I hate to use the word conservative because equities are always going to be volatile, but we feel buying inexpensively priced stocks gives you some downside protection along the way.
Yeah, well, what I really appreciate about the election newsletters that I was forwarded before we chatted was just looking through your headlines. Returns and lead up to the elections, right? Returns 1 year before and after election day, returns by presidential term year, returns by president. It's very data driven. And it's like, look, this is just kind of what happened, right? And then in the second one, you gave your idea of if Kamala Harris wins, this is how I would do it. If Donald Trump, these are what we're looking at. And I just thought it was very well reasoned and sort of, I'm just going to say no bullshit. I mean, it's like very data driven, and like it's not so many newsletters and so many newsletter writers are tap emotion in order to sell something. Right. And that's not how you write. And I appreciate that.
Right. Well, thank you very much. I'm glad that it is appreciated. The numbers can be boring, right? It's not sensationalistic, but the actual headlines are. It's like, well, for example, many people these days think that if there's a Trump presidency, that somehow will be great for the equity markets. And if there's a Harris presidency, that's bad for the equity markets. And market history shows that stocks do better under Democratic administrations than Republican administrations. It doesn't mean that I'm voting one way or the other. I'm just saying that this is the data.
Yeah.
And so if somebody's out there telling you, well, happy days are here again if Trump wins and it's the world is ending if Harris wins, it's not supported by statistical numbers. It makes for a great emotional story, but it's not likely to help you grow your wealth and preserve your wealth by reacting to those sensationalistic headlines. So we just try to, I don't want to say debunk myths, but there's a lot of stuff that gets passed off as factual because it's somebody on CNBC, a talking head who says it must be true. But often it's not. I mean, and then you look at, it gives me material Let's put it that way.
Yeah.
I'm constantly trying to challenge what folks are hearing. And I think that provides some value to our readers and our clients, is because I'm anticipating, hopefully, the questions that they might get, such as, what happens if Harris wins? It's going to be the end of the world. Well, I'm not going to make any political statement to you. I'm just going to tell you, here's the data. And the data says, if that's what you care about, then if all you care about is D or R and how stocks do, they do better with D.
Yeah. Well, shouldn't I buy energy if Trump wins?
Exactly. And that's what was fascinating in the piece that we put out, is that, believe it or not, in 2016, the first Trump presidency, energy was a horrific investment. The energy sector of the S&P 500 lost something like 18% per year for the 4 years of the Trump presidency.
Yeah, I've got 15.8 is what you wrote.
15.8.
Yeah.
So 50%.
Some of that's the ending point, right?
Yeah. But and it's fair, but that's the other piece of the puzzle, is that you also have to remember that stocks have already moved, right, in anticipation of some event that may or may not occur. And we wrote about that in our reports. There was opportunity in healthcare with pharmaceuticals back in the Clinton administration, when Hillary Clinton was going to be not the border czar, but the drug pricing czar. And the stocks got whacked on worries about whatever price controls would come. So that allowed us to buy a name like Merck, which was a high quality drug maker back then. And we made 300 and some odd % on Merck, thanks to the Hillary Clinton drug pricing scare. So we're seeing things like that today, where certain sectors have already been hit, or other sectors may have been bid up in anticipation of whatever result might occur. So it's a very important thing to consider, is that stock prices have already moved in anticipation of some future event. And so there's not ever a period where, we've all decided that today is the end of our thinking, and nobody's looking beyond today to tomorrow in terms of how they evaluate stock prices. It's always forward looking. And so sometimes history comes as you think it will. I mean, NVIDIA has exceeded wildest expectations, right? So was it fairly valued?
But that's one that's similar to Apple, right? That was a left for dead value stock back in the day.
Right. We owned it. We owned it in the day, and we made our 300%, and we felt that was sufficient, and we got out. Remember, because they were a graphics chip maker. And hindsight's 2020. Boy, we wish we could have understood that graphic chips require tremendous computing power, and then the applications beyond graphics can be enormous. But all candor, we didn't have that mindset at the time. We felt the stock had run its course, and we got out of it. And we follow it. I followed it for a long time. We just haven't been able to get a price at which we're able to get back in. But that doesn't mean we haven't benefited from many of the AI trends. A name like Broadcom we own, and we bought Broadcom quite a while ago, but it had a 3% yield. It went into our income-oriented strategy, believe it or not, because it had a big dividend yield. We own Seagate, which is data storage, and Seagate had a big dividend yield. Corning had a big dividend yield, relatively speaking, of course. And even Apple, Microsoft, and believe it or not, now Alphabet and Meta are paying dividends. So you can have some super successful stocks that are paying dividends. I know you mentioned you'd rather they bought back stock.
No, it's a debate I have with people. I don't actually have a preference. I think your shareholder base matters. So as long as you do what your shareholder base expects, then whatever.
I'd say why not do both? Yeah. And that's the beauty with these companies, is they have such cash. They can buy back stock, they can pay a dividend, and they can invest to grow their business. And what we don't want our businesses to do, or our successful companies to do, is to go out and buy something because they have cash burning a hole in their pocket if they're buying something that isn't going to help grow the business over time. Yeah. And that's obviously the challenge, right? They're empire builders in management. Boy, if I can just acquire this, this, and this, then think how great it's going to be. If we remember back in the General Electric days, the conglomerate was the greatest thing in the world. And Jack Welch was the greatest manager in the world until he wasn't. And then all the Jack Welch, the coaching tree from Jack Welch, maybe I'm talking about guys who nobody knows about anymore, but the coaching tree from Jack Welch, all those guys were supposed to be heroes, and they didn't turn out to be great either because they were from a different era. And so anyway, the moral of the story is that stick with stocks through thick and thin. Don't let the emotions and the headlines of the day get you off course from your long-term investment objectives. But even more importantly, you should establish those objectives in a quiet time, not in a turbulent time. Probably not decide that you're going to go from 70% stocks to 20% stocks today because of the election, or vice versa. You think, oh, there's going to be election, Trump is going to win, so that's going to be great for stocks. So I'm going to go from 70 to 100. Set your allocations and then make modest adjustments along the way. And that's where I think a professional wealth manager like our shop can be very helpful to people.
Yeah. Well, I agree. I have nothing to add, as the late, great Charlie Munger might say.
I appreciate that.
Yeah.
Well, as Charlie also says, never interrupt the compounding. So that's the moral of the story. Don't do something stupid to interrupt it. Obviously, if you have short-term cash needs, take care of those. And if I have clients, I had one today who, needed some money in the next couple of weeks. I said, let's sell today to raise your cash. I'm not a 2-week trader or investor. If somebody needs money and has short-term needs, that shouldn't be in the stock market. But long-term assets, in my mind, the stock market's a great place for those with time horizons of 3 to 5 years or longer, especially as those time horizons are often understated. Your time horizon is often a lot longer, especially for the bulk of your assets. You may say,
you're saying what it should be.
Yeah, it should be.
Yeah.
It should be. Yeah. It should be a lot longer. You say it's 3 to 5 years, but in actuality, that's understated. It might be 10, 15, 20 years. Nobody wants to lose money, of course, in the short run. But you also lose opportunity by sitting in cash and trying to sit out whatever event might have occurred. We can even look, one of the other things we study is, Arab-Israeli conflict. It's now been a year since October 7th. And you could have said, well, that's going to destabilize the Middle East no matter what. At the least, it's going to destabilize that. It could be even worse. And frankly, it probably has been worse than many people might have envisioned, what has gone on there. And yet S&P 500 is up something like 30 some odd percent, since then. So again, lots of traumatic events occur. We talk about them in our charts and our data, and history doesn't repeat, but as Mark Twain says, it often rhymes. And we think that equities will continue to be rewarding. And we think there'll be lots of scary headlines, but they'll still manage to persevere as the economy grows and as corporate profits grow over time. It's not magic or witchcraft or something like that keeps stock prices growing. It's to use an election campaign speech thing. It's the economy stupid. It's corporate profit stupid. I mean, they grow over time. That's why stock prices increase. Again, a lot of people view it as like a casino. When I just got to get lucky and it lands on red, or the dice come up 6 instead of 7, I'm going to make money. No, if you just don't screw it up by trading too much, the odds are in your favor. Equities rise over time. They don't fall over time. And so you just have to be, again, disciplined and stick with it through thick and thin.
Well, thank you. I'm closing on that message because I think it's one to close it on. But thank you for joining the show, and thanks for being articulate about your message. And I enjoyed reading the episodes I got. So appreciate you sharing them.
Appreciate your interest. Thank you.
All righty. Have a good one.
Absolutely necessary.